Welcome, everybody. I'm John Scott, and this is Kristen Reinking. We are with Summit Virtual CFO Services by Anders, and today we want to talk about profit-focused accounting. Before we start, though, I want you to ask questions along the way, and when we get to the end, we will provide a QR code that will allow you to go back and look at a previous recording of this presentation in case you want to review anything that we go over. So we've been doing profit-focused accounting for about 20 years, and we're going to hit the highlights of the different areas that we'll talk about here in a few minutes. But before we start that, we want to give you the definition of profit-focused accounting. And typically, we don't read off of slides, but I'm going to read this one because we think it's really important that you understand profit-focused accounting and what it means to us. Profit-focused accounting is a system designed to help a client accomplish their financial goals by breaking down their revenue into non-financial drivers. Unlike revenue numbers, non-financial drivers can be consistently controlled and monitored through clear metrics that are then used to determine a client's revenue forecast. Finally, the amount of expected revenue in the client's pipeline is used to inform and adjust the forecast. This is a key concept, adjusting along the way. So there are four metrics that go into profit-focused accounting, and the key pillars are cash, production, financial, and pipeline. They're all important to the process, and you'll see how they work together. Lastly, we will provide you with a tool to help you further understand this and give you some examples. It's really a booklet that was written by one of our partners, and it'll help you navigate your journey from getting from point A to point B. One of the most important things in understanding is cash. Cash of the four pillars, in my mind, is the most important. It helps you, if you have enough cash, sleep at night, and then you can make strategic business decisions. Conversely, if you don't have enough cash, you don't sleep at night, and you get very stressed out and you make reactive decisions, not good business decisions. So how much cash do you need to operate your business? And we think there are two rules of thumb, and it's important to recognize these aren't mathematical calculations that are very detailed. They're really just guidelines or goalposts based on your business of how much working capital you will need to set aside to run your business and for taxes. So the first rule of thumb, the first bucket of cash to cover payroll and monthly expenses is really 10 to 30% of your expected revenue. And then the second bucket is to set aside money for taxes. It's incumbent upon any business to be able to pay their taxes along the way. And whether they pay taxes at a C Corp level or it's a flow through a partnership, S Corporation, you have to be able to provide that liquidity to cover those taxes. We use 40% of expected net income for that bucket. So if we look at two identical companies with the same income statement, both have $3.5 million in revenue and $655,000 in profit. The 10% company needs about $350,000 in revenue, while the 30% company needs just over $1,050,000 or about $1,050,000 in cash. What's the difference? The difference is risk. Each business has a different set of risk factors that determines how much cash they need to have on hand. Again, this is easy math. It's not meant to be exact. It's just giving you a target, because when you ask most business owners what their revenue is going to be, they can determine that number. They can tell you what their expected revenue is going to be, and based on their risk factors, you can then decide how much working capital they should keep in their operating accounts. So let's talk about those risk factors. A 30% company has a few large clients that don't pay on favorable terms. They might have a weak pipeline of work. They might be expecting a big purchase in the near term, so they want to squirrel away some cash. And on the other end of the spectrum, a 10% company has lower risk. They have many diversified smaller customers, high recurring revenue, and clients that pay by return mail. It's just the importance of this is to determine where you fall within the spectrum, and you're probably not a 10 or a 30% client, but you're probably somewhere in between.
So what do we really see out there, John? Majority of my clients are at the 10%. I have had clients who have been at 30% before. Some examples of people who are at 30% is I've had an $8 million company that has only 2 clients. And by the way, they did lose one of the 2 clients. What the 30% really of cash reserve really allows you to do is when something like that happens, it allows you to take a breath, know that you have some fallback cash to make some good strategic decisions rather than very reactive decisions, and gives you a little bit of a timeline going forward. There are a few folks who hang around that 15% like John was talking about rather than hanging out on the ends. And sometimes it's based off of being a little bit more conservative in nature.
Totally agree. And remember, it's dependent upon the risk of your individual business. So you'll have to decide where you fall within these 2 guidelines. All right. Now we want to talk about cash accounts and what those should look like at your bank and on your general ledger, what kind of accounts you should have and what their purpose is. Before we look at the 4 areas that we think are sources of cash reserve account, tax reserve account, and then on the flip side of that, your line of credit, we need to determine and understand how these accounts are affected by your cash flow cycle. So this is a number that you can calculate. It's a more mathematical formula than the rule of thumb 10 to 30%. So let's take a look at the cash flow cycle and what affects it. Understanding your cash flow cycle is really just understanding your annual revenue divided by the days in the year, multiplied by your usage, which is your AR days less your AP days. So remember, our 10% target is 350,000, while the 30% target is 1,049,000. In our example, whatever number we come up with, we can make adjustments. We can adjust our AR days downward. We can increase our AP days upward and change this answer if we don't like the result that we get. So let's look at our example and what the results are. $3.5 million in revenue divided by the number of days in the year. We collect our AR in 45 days and we pay our bills by return mail in 5 days. So doing that math, we come up with $383,000. It's between our 2 rules of thumb. It's probably about 12%. And remember, if we need a bigger target, if we need to be at 15% and we want to increase this number, we can shorten this usage period by getting better billing and collection procedures in place, paying our bills a little bit slower. We can influence this number to get to the target we need. So the cash reserve account we think should be split into 2 different accounts. One being the operating account from which you're going to pay your payrolls and rent, and then sweeping the excess into a cash reserve account which earns some interest. And we think you should monitor this at least weekly and move money back and forth. You know, you can do this online, it's not a big deal. But if you're running into cash crunches, it's important that you hold internal cash flow meetings to keep these accounts at the correct levels. So the next item is taxes, and this is really important. Remember, we said that businesses making net income need to put aside money to pay their taxes. This is one of the areas a lot of small business owners don't always think about in advance and get themselves into trouble. So when you set that money aside as it's earned in an interest-bearing account, you'll have the money to cover not only the estimates that are due, either by the entity or by the owners, but you'll have the balance due when that time comes. So we want you to segregate that money. So let's look at our example. We use 40% as a rule of thumb for this, but that comprehends a federal rate and a normal state rate. If you lived in, or your business was in California or New York, 40% is not going to cover that. You probably need 45%. Conversely, if your business was in Florida or Texas, and that's the only place you did business, you might be able to get away with a smaller percentage, maybe 35%. But in our example, $655,000 times 40% is $262,000.
You know, the tax reserve is so important. When new clients come to us, I would say 1% of them actually have a tax reserve of some sort. And if anything, they come to us in a situation where they have a tax liability that they don't have the cash for. You know, it's not uncommon for people to have to take like 401k loans just to be able to pay their taxes, and then the 60 days cycle back. And You know, I have seen that several times, and what we do is we get them in a position where they have their tax reserve. And just like John said, when we make the money from a cash side, that's when we should reserve the money. When we have the money, that's when we should move it over. And this is one of the things John referred to, is that giving you a peace of mind, being able to sleep at night. Taxes is one of those things, and it has been very beneficial to our clients because we do keep that tax reserve, and so taxes become an easy event.
Totally agree. And I call it delayed gratification. If I earn $1 of income, it's not all mine. I have to hold back some for taxes. And if I do that, then the next dollar that comes in, I am able to take. So let's talk about how taxes get paid and how we like to operate that tax reserve account. Estimates are due on a quarterly basis. And again, whether it's at the entity level or the individual level, you're going to pay on one of two safe harbors, either 110% of last year's tax number or 90% of the current year tax number. So in our example, the estimates are $50,000 a quarter. Now remember, we're setting aside 65.6. So in that first quarter, let's say it's a flow-through entity, we're going to distribute 50 for the owner to pay their taxes, and we're going to keep that excess in our tax reserve account earning interest. And over time, we're going to build that account so that even though we've distributed $200,000, that $62,000 and plus the interest it earned is sitting in our tax reserve account and is there to cover the balance due when the owner files their taxes. Okay, so let's review before we get to line of credit. The operating account is where we house the 10 to 30% of revenue. The next question that comes up is, what type of line of credit should we have? What size? How often should it be renewed? What kind of terms should we have? Really, we think the line of credit should be equal to this 10 to 30% number. And we feel that that gives you a big safety net so that if one of your really great customers struggled and they were going through a short-term crisis, you can hit that line of credit to cover that shortfall. You're going to stick with that client. You know they're going to be back. It's really a short-term financing thing in order to keep going and paying your bills without getting stressed out.
Sometimes I refer to the cash reserve that we create as creating our own line of credit. So normally my clients do not actually need to hit their line of credit. However, I always recommend you have a line of credit equal to about 10% of your preceding 12 months revenue, which is just easier to calculate than saying 2 months worth of operating expenses. But the best time to get a line of credit is when you don't need it. So be sure you get one.
Totally agree with that. And not only get the line of credit when you don't need it, but try and get the renewals so that they're for longer periods of time. If we think back to the financial crisis in 07 and 08, and even more recently, the pandemic, many line of credits were diminished or eliminated by the banks. And so you want that renewal period to extend out as long as possible. There may be a fee to pay, but the peace of mind that comes with having that line of credit in place beyond some calamity, it sure helps you sleep at night and operate your business well. So the other really important thing to understand about cash flow is how you can how collecting your accounts receivable can make a big impact on your cash balances. Does the timing really matter? And yes, it does. Here's an example of someone who is collecting their AR on a 60-day turn. They started out at 20, and in that first month, they had to either move additional money over or borrow on the line of credit because their operating accounts went negative. And so by the end, they've recovered some 150,000. But remember, that's nowhere near even our 10% target. If we could somehow shorten our AR days to collect, our AR turn, by 15 days, you can see that we never go negative. This is an $80,000 change in the first month. And by the end, we're at $230,000, still short of our target, but we've improved. And then somehow, if we could shorten it even further, down to 15 days, we're well within our targets. And you can see the power of having good billing, collection, hygiene, and processes.
Hey,
You
John, I
know,
want to relate this back to the cash reserve. I had clients, especially around the time of COVID, who had a strong cash reserve in place. And so what that allowed them to do is they would almost use it as a sales tool. They could have a payment cycle that extended further than most to allow them to win the business. So if you have strong cash, it allows you to make more strategic decisions and gives you that extra tool.
That's a great example. I also like to cite the example of Anheuser-Busch selling to AB InBev, and AB InBev paid a big premium. And of course, the entire world in St. Louis wanted to be a vendor of Anheuser-Busch and continued to be a vendor of AB InBev. But what they did to pay down that debt quickly and improve their cash position was they told everyone in the world that wanted to work with them, hey, we don't care what your payment terms are. We're going to pay you in 45 days. And if you want to continue to work with us, that's fine. But it improved their cash position, and they also cut a lot of cost. They were able to pay down the debt that they borrowed to make that acquisition. So you have tons of levers here, either on the AR side or the AP side, to improve your cash position. So the next section we want to talk about is production. And this goes back to a lot of what we talked about in profit focused accounting. But before we get into the production metrics, we want to outline the difference between budgeting and forecasting. Budgeting is a one-time event. You're going into the year and you're saying, this is what I want to do next year, 3 years, 5 years from now. If you think about it, it's like taking a trip and pulling out an atlas and saying, I want to go from St. Louis to Naples, Florida. Here's how I'm going to do it. You're going to make some notes and off you go. A forecast, on the other hand, takes into account things that are happening in the environment along that journey. And if we use the same trip analogy, it's a lot like using a Google GPS or a Waze app, and you can anticipate things in the environment that are going to affect your journey, and you can make adjustments to account for that so that you can stay on plan. So budget or forecasting requires you to look at it more frequently and constantly make adjustments to get back on path. And I want to point out that early recognition of the need for an adjustment makes all the difference. If you notice that you're off plan in March, you have the remainder of the year to correct that. But if you don't pull that forecast out until October and notice you're way off plan, you don't have enough runway left in the year to get back to your destination.
So true. So clients come to us and they're used to budgeting once a year. It's our once a year event, right? That's what we refer to as a budget or a plan. What we do is we, on a monthly basis, look at a forecast. It's where you're dynamically looking at revenue, expenses, cost of sales, people, everything that's affecting things, because the world is not stagnant and you don't know all things in the December or November before the prior year. So we like to call it a living document, and it allows us to make more strategic decisions rather than the once a year detailed look at it.
So now that we understand the difference between a budget and a forecast, let's take a look at revenue drivers. And revenue drivers are different for each business. I don't care if you're a marketing company, a law firm, CPA firm, metal manufacturer, you can determine what drives your revenue. In a service-based business, it's the number of people you have, how many hours they can do it, and what rate you can charge for them. So we're going to go through 3 different, very simple examples. The concepts apply to complex businesses, but we're going to simplify it so that we can explain the dynamic forecasting in 3 different areas. But knowing your revenue drivers is really important. So what drives your revenue? If we first look at a service-based business, really this is what rate can we charge and how many hours can we bill? So if we have a law firm or a CPA firm, we're selling time and knowledge. People are the revenue drivers, which is a function of the rate per hour and how many hours can they charge. It's very simple to understand, and it is key to forecasting in a service-based business. So here's some additional detail when we break it down. We really have 3 factors. It's the standard bill rate, the average bill rate, and the effective bill rate. Now, the standard bill rate is what you tell the world you charge your people out at. And you can look at this one of 2 ways. You can look at it by level, at the partner level, the manager level, the associate level, or you can do a blended rate. We do both. But The partner has a higher rate because of their experience and their efficiency. The new associate has a lower rate because they are less experienced and less efficient. But the key thing is, this is what you're telling the world you're charging every hour at. The average bill rate is a function of what value the client actually gets a bill for. So whether it's a time and materials environment or a fixed fee environment, you look at how many hours you had at your standard bill rate and you determine, okay, my fixed fee was $2,000, but I had $3,000 in the project, you're writing down $1,000. Same thing in a time and materials. I could have $3,000 of time in a project, but when I go to bill it, I realize that, hey, I really had an inexperienced person here, or our processes weren't great. The value is only $2,000. So again, you're going to write that down to what the value is that the client perceives and you feel is fair. And that's your average bill rate after those write downs. And then effective bill rate, we're going to introduce here, but talk more about later. This really is total revenue divided by all the hours that you pay someone, whether they're charging a client or not. And this is an important number because it tells you the dollars that they're bringing in for every hour that you're paying them. But we'll highlight how important that number is later on in the presentation. So when we build a forecast for a service-based business, we have to look at the days available. We can't just say that 260 days in the year divided by 12, because that's not how the calendar lines out. So you can do this from Googling it or using Excel to come up with this number. And then next we look at how those days fall within the year, because each month is a little bit different. And remember, we're building a dynamic forecast based on each month so that we can look back and check variances each month. So once we have our days available, if we say that 8 hours a day is what we're going to work, we can build a full-time equivalent of 2080. This doesn't comprehend PTO or holidays. We're going to get to that on the next line. So when we look at all the hours that are available, we realize that people take time off, they get holidays, they have training days, there might be a retreat that we do for people. Not every one of those full-time hours are available to bill. So in our example, we've come up with 408 hours of what we call culture time. And then when you subtract that out, it gives us the total available hours that people have that they could be billing clients, 1672 in this example. Now, we have to set a weekly expectation. Of those available hours, how many do we expect a full-time equivalent employee to bill? We've picked 75% for this example. And when you do the math, 75% of the available hours is setting a billing expectation of hours of 1,254 hours per full-time equivalent. Now, utilization is a key factor here. And again, I can't harp on this enough. Utilization for the year is 60.29%. And we get that by our total billable hours divided by our total working hours. When we look at 60%, we can't divide it by 12 and say that every month is 60%. We have to look at it on a monthly basis.
Right. And what's interesting is, especially around the holiday time, when you're a service-based business, you can see the effective rate went down to 37.5 and 54. And so when agencies or companies get their financials back and they're like, oh my gosh, I lost money this month. It's okay. We forecasted it. As long as we're hitting that 60% from an annual perspective, as long as we're hitting the monthly forecast, we'll still get to that 60%. That is our target. And so it isn't a failure. It was expected.
Oh, I agree. So this is just an example of what Kristen said. When we look at this on a monthly basis, and each month is going to have an expected utilization of a different amount. So as Kristen said, if we get to May and we're at 55% utilization and we think, oh my gosh, we're way below our annual rate, we're actually doing better than we thought because we only predicted 47%. So each month's going to be a little bit different, again, based on days open, how many hours we have, what expected PTO or culture time that we have for those months. It's going to drive that utilization number. And then we're looking back at average bill rate. Remember, we had our standard rate of 180. We wrote it down $16. We've simplified it here so that each month is the same, and our average bill rate is 164. Again, the average bill rate accounts for inefficiencies. It may indicate that you need training and improvement in your efficiencies. We target a write-down of 5 to 10%. More than 100% is a problem in that, remember, we're setting out average or standard bill rates based on experience and their knowledge, their efficiency. So if I'm consistently writing someone up 5 or 10% or 20%, I don't have their standard bill rate set correctly. But 5 or 10% of a write down is a good target, hopefully skewing more towards the 5%.
Yeah, I think traditionally 5 to 10% is considered acceptable. However, in working with different clients, I find that most people are between 2 and 5%. At 5%, depending on the type of business and what all is going on, it may be very acceptable and very predictable. But in most cases, even at 5%, there is probably opportunity to do the things that John was talking about to improve the average bill rate. And you can get that right down to about 2%. I find that to be pretty common as well.
That'd be great. So now that we have all this, we can put this together. We have expected charge hours of 1,254, an expected average bill rate of 164. We know that any one individual could contribute $206,000 to our activity. And then, of course, we want to look at how many full-time equivalents do we have. And I can't just count the head counts. In this example, we have 17 FTEs. Think about this as 10 full-time producers, younger people. Their only responsibility is client work. And then I have 14, I'll call them part-time producers at half-time. Those folks are more experienced. They are doing client work, but they're also doing administrative functions within the company. So we have to look at our universe of employees and look at those partial people and say, okay, they're half-time production, half-time this. They could be 60, 40, whatever the number is. When you come back to full-time equivalents, that's the number we're going to use here to forecast our annual revenue, both annual and by month. And again, you'll see it plays out differently every month, so that when we're looking at actual revenue for February, if we were above 351, we would know that we exceeded our forecast, and we could dig in and find out why. And if we were well below our forecast, we'd want to find out why as well. So that's why we do things on a monthly basis rather than just dividing by 12 for the year. That doesn't give you any information that you can look at and analyze on a regular cadence to give you to explain the variances.
And remember that the forecast is your guideline. I mean, that's the source of truth. That's what we measure against. So, so understanding the variances that John's talking about on a monthly basis will allow you to be able to make the changes you need to be able to be successful going forward.
So now let's get back to what we talked about earlier, and we said we would talk more about the effective bill rate. This is the one that you can calculate it 2 different ways. And the first way is the revenue you produce for the total hours worked. And that's the definition we gave you before. This is saying for every hour that we're paying an individual, they're bringing in $99. The other way to calculate it is looking at our utilization rate times our average bill rate. You can see the result is the same. But with this calculation, you can manipulate this number. If this isn't enough revenue, you can increase their standard rate, increase the efficiency. By increasing the standard rate and their efficiency, you can get the average bill rate up. Or you could say, hey, that weekly expectation we gave you, we'd like you to increase that by a couple hours every week. Tweaking either one of those numbers increases this effective bill rate and influences how much revenue you can bring in and how much gross profit you can generate. So again, we do things on a granular monthly basis so that we're not just looking at $99. We know that early in the year, we're more productive. We're more of our business is here. We're in the office more days. When we hit early summer, we drop down. August, it starts to pick back up. And when we get to year end, things really start to fall off the table. And if you think about that, that's logical, right? We have a lot of holidays in there, unused PTO. We're not going to be as productive at the end of the year. Each business is different, but in a typical service business, it's going to fall off at the end of the year. And again, that's why we want you to pay attention to this along the way so that you can have time to make adjustments, because you don't have enough runway in October to fix. Effective bill rate is not high enough. All right, our next example is a coffee shop. This could be any retail store where the sale is immediate. It could be a music store that sells guitars and drumsticks, or it could be a restaurant or bar. We're going to use a coffee shop. And there are really three factors that influence it. It is our average ticket cost, the number of daily customers we have, and the days that we're open. Those are the revenue drivers that affect a retail shop. So let's break down the calculation so we can understand how these relate. If we look at our open days, again, we're going to look at the calendar. We're going to account for every day in the year and determine what days we're not going to be open. The result is down below. You can see that we're not closed that many days, so we're open most days. And then when we want to forecast daily customers, the best place to do this for an existing business is looking at your point of sale system. You can look back. Point of sale systems have a ton of great information in them, and you look back and see how many customers you had each day, and that's where you should start for this. If it's a brand new business, you're going to want to talk to peers and try and get the best information you can get, but realizing that over time you're going to refine these numbers and your forecasts are going to be better and better. Okay, so in our point of sale system, we have the last 2.5 years. You can see we opened in May 3 years ago, and we were at a high water mark for customers, 225. Then it kind of tailed off. We began the most recent year at 208 and ended at 213. We need to adjust for this outlier right here, this May number. And so when we adjust for that and we take it down to what June is, we're normalizing those numbers so that we can look at trends. The first trend we'll look at is average, and our average numbers, that's not going to tell us too much. I'd really rather look at a growth rate. And in the first year, we went up to 2.6%. In the most recent year, only 1.5%. So if we forecast similar growth in our daily customers, we think that we can get 211 at the start of the year and 216 by the end of the year. And lastly, we want to look at our average ticket price. And again, our point of sale system is the source of truth for that. And we can see that the grand opening month, we had $6 average ticket price. And that doesn't line up with the others. So it's really an outlier. We ended the most recent year at 1114, but we're going to adjust for this outlier and change it to what the June number would be, 951. And again, we're going to look at growth rates. The first year we raised prices 10%, the next year 8%. And we have to project out what we're going to do for the forecasted year. And we chose 8%, but we've had a ton of inflation lately. And if our product costs have gone up 15% and our people costs have gone up 10%, 8% is not going to cut it. But whatever that number is in your forecast, you can play with that here. We're going to use 8%. When we put all this together, we're looking at the days we're open, the tickets per day we expect, and the average ticket cost. We're creating a monthly and annual forecast that will help us determine what we expect for each of those months. If we get to February and we expected revenue of $71,000 and we'll only have $60,000, we need to dig into that and figure out what happened. Could have been a major weather event. If I'm a restaurant that is by a sports facility or a concert venue, entertainment district, and there are a lot of things going on, I'm going to forecast based on that. You know, we happen to be down by the Cardinals, Busch Stadium, and Ballpark Village. Typically, the Cardinals draw 3 million people a year, so I'm quite sure that the restaurants and bars around the Cardinal facilities forecast based on the Cardinals being in town or not in town. If the Cardinals are underperforming and they don't draw 3 million people, those forecasts are going to be blown because they expected every homestand to have a certain amount of revenue volume. But because the Cardinals aren't performing well, people aren't coming to the stadium. When they look at the variance for those summer months when the Cardinals were going to be there, they can dig into why that happened. And one of the reasons they're going to point to is people didn't come downtown to go to the games, so our revenue forecasts were off. Okay, our last example is a subscription-based fixed fee cleaning business. So our revenue drivers here are the number of contracts we have and the price per contract. It doesn't matter what kind of business you are. If you're charging a weekly or monthly price to perform a service, this forecasting will hold out. The first thing you need to determine is your total capacity and your team's capacity. And you can see here we have 6 part-time employees, 3 of which have capacity for 5 cleaning contracts a week, 2 have 4, and 1 has capacity for 2, giving us a total of 25. And then we have to look at the existing contracts we have, how many contracts we have, and what the weekly price is, and who's doing those contracts. Remember, Brian and Sue had capacity for 5, but they have 3 contracts each. So the next couple of jobs that we get are going to those 2 folks. And then you have to ask yourself 3 questions. 1, how many contracts do I think I can add, and when will I add them? How many do I want to add, and how many do I think I can add? What's the price point for those new contracts? And then lastly, and very important, is what is our expected churn? So with 1 and 3, we have to determine not only how many, but when it's going to occur, because it impacts our forecast. These are our existing contracts, 15 contracts. They range from 150 down to 125. And we know that people are going to move on from us. They may move out of the area, no longer need us. They may have a change in family status where one of the spouses is now at home. They can't afford us, and they can't need us they don't need us anymore. So we're going to lose, we're saying 5 contracts. And when we lose a contract is very important. So if we lose one in March, it hurts our forecast a lot more than the one we lose in November. And conversely, when we gain a contract, it's the same thing. If we get a new contract in January, we have that for the full year. Neither one of those affect the next year after our forecasted year, because we'll have those for a full year. But when you lose or gain something is important. Okay, same thing on new clients. We think we can add 2 new clients a month, and we've just spread this throughout the year. So 2 in January, 2 every month up until December. And again, the 2 in January, even though they're a lower price point than the 2 in December, are a lot more valuable to my forecast in the current year because they're there for a full year. All right, when we put all that together, we start with our existing contracts, and we're comprehending the losses here along the top, and we're adding 2 new per month. So we have 17 clients in the first month of the year, and at the end of the year, we have 34 times the weekly revenue. Remember, we determined a price point. We're coming up with monthly expected revenue. Now, I want you to focus on this 34 because we only had capacity for 25. We have filled and exceeded that capacity. So that tells me we had to find at least 2 new people, if not 3, on a part-time basis to have room to grow additionally. Okay. The next section is financial. And these are your financial statements. We're going to focus on the income statement and really understanding how all these pieces come together. I want to talk about, because we get this question a lot, is what should net income be from a business? And I'm going to briefly talk about probably 10 to 25%. And if you get less than 10%, I really question, is it worth taking the risk and the stress of owning your own business to only make 10%?
Thanks, Don. Yeah, for service-based businesses, 10% would really be an absolute minimum. When we're thinking about forecasting, which remember is our roadmap towards the future, we like to forecast for at least 15% because we know that along the way, there are always going to be unforeseen obstacles. So it gives us that 5% buffer. And just as you alluded to when we started this presentation, is you start your business with the exit plan in mind. And when you're thinking about exiting, 20% is really the target net income you really want to have for like the 3 years prior. So it's considered excellent. So excellent companies would be 20% or greater. Minimum forecast 15, and then minimum is to hit that 10%. And by the way, 25% is very doable. I do have some clients that hit around 33. So some of that comes with scaling, but definitely small to mid-size clients can hit 10 to 25.
So when we break down your income statement, we want to do it in a very simple manner. And this is what you're going to present to the ownership group or the stakeholders so that they can review things in very simplified buckets. It's not how you're going to run your general ledger or report taxes, but the key is putting things in the correct bucket in a simplified manner so that you can monitor things over time. And the first part is, what are those efforts that go into production? Remember, we had the 17 full-time equivalents. So we're looking at an average salary. You can do this on average or in detail, but the average salary of $75,000, we're going to increase that for the burden rate, which is all those costs associated with having an employee, not just their salary. And so when we do that math, we come up with the average team member cost us $96,000 times full-time equivalents. Our cost of goods sold number, fully loaded, not just their salary, but all their cost, is $1,632,000. And again, burden is average employee burden over average salary. So let's look at the details of what makes up burden and how we came to that 28%. We're looking at all the costs associated with employing them, not just payroll taxes, but 401k match and their insurance, any technology or educational spends. In this case, it's $20,638. Take that by the average salary. That's how you get the 28%. So tying that back, our cost of goods sold is $1,632,000, and this is going to result in how we determine gross profit. And gross profit is extremely important to track because it's what allows you to pay all the non-revenue producing expenses for your business, including that 10 to 25% profit. So if you can increase gross profit 5, 6, 10%, most of that drops to the bottom line.
So remembering that our bottom line goal is at least 10%. And for small to medium-sized clients, 35% is the normal overhead. So doing the basic math, your gross profit that you'd want to achieve as at minimum would be 45%. In this example, you can see 53. That would allow you hopefully to get around that 18% profitability that we were looking at before. So as John was talking about, if you want to increase your bottom line and you're a small to medium-sized company, it's usually in the gross profit area and increasing that overall percentage.
So here's our gross profit, and here's where I want to tie in the discussion we had about the effective bill rate before. Remember, we said that each person for every hour that we're paying is contributing $99 of revenue to our forecast. When we focus on the production piece of this and it's fully loaded, we can come up with their effective cost per hour as well. This is just another way of looking at our gross profit, but on a per person or per team basis. So $99 is what they're contributing. They're costing us in direct costs $46. If we want to change things, remember, we can affect that effective bill rate. We can tweak that up by increasing our standard rate or our number of hours billed. We can increase that gross profit percentage. That's what we just talked about in the prior slide and how that will increase our net income.
As a general rule of thumb, you want your effective bill rate to be at least 2 times what your effective cost is. So when you say to yourself, what is a good effective bill rate? honestly, it's dependent on what your cost is. So 2 times your cost is generally a good starting point.
But by doing this math, you can monitor those things and keep track of it and not be shocked at the end when you didn't get to your destination. Okay, so the next section we want to talk about is overhead. And these are all the costs that are associated with non-revenue producing. We have administrative cost. This is kind of a catch-all for things that don't fall into marketing facilities, but it's really the non-revenue folks. And again, this is fully loaded cost. It's payroll plus benefits, any office supplies, professional fees, etc. Then we go to marketing cost, and marketing costs are your business developers or any sales efforts. And remember, the owner might be doing some of the business development, or some of the owners might be doing all of the business development. So we're going to take a piece of their cost and throw it into the marketing cost, not just the traditional marketing expenses. And then lastly is facility cost. This is your rent, utilities, common area maintenance, but also post-pandemic, and even in our own company, some of our people are completely remote. They're fully distributed. You have some companies that are fully distributed, some are partial, they're hybrids. And so just because you're not paying rent for that person doesn't mean that you shouldn't capture technology cost of setting up their office at home, any reimbursements you give them to make their work environment better, company retreats where you're bringing them together to build some culture or sending them to training. Some of those things need to be allocated to this facility bucket. Whether you're paying a rent check or covering their home office, it should be in this bucket. Okay, this is kind of what we just talked about with the owner holding or wearing many hats. Many owners are still in client service. In this example, it's 60%. They're doing some business development, and then they're running the business. So when companies get bigger and more mature, that's when you see owners more in the running the business and less in the production or business development. But small to mid-sized businesses, that owner is wearing many different hats. And when we look at their compensation, I want to do two things. One, I want to make sure it's fair for what they're doing. And two, I want to put it in the right bucket. So if my owner, 60% of their time is in production, I need to have that up in the production piece so that my gross profit is an accurate reflection of what it actually is. So this generates $950,000 of $55,000 of operating income. Let's look at the owner's comp line. Again, when we said that you should be entering a business or operating a business as if you're going to exit it and sell it at the highest multiple, the buyer is going to look at what you're paying your owner and what they're doing. And they're going to make adjustments up or down based on the fairness of that compensation. So we looked at some information from pay scales to look at what a typical CEO would make, what a typical COO would make, and a CFO. And if your owner is wearing one, two, or all three of those hats, the compensation has to comprehend that. Because if you're paying them $300,000 or your ownership group $300,000, but in reality, an investor buyer who's going to come in and theoretically pay you a premium for that business knows that, hey, they're going to have to pay $450 for those same functions because they don't want to do them. They're going to make an adjustment in their EBITDA calculation, and it's going to lower the price of what you're going to get paid. So you want to pay fairly based on the market for what the owner is doing. Okay, the final section is pipeline, and pipeline is a really important metric that a lot of companies understand when it comes to the sales aspect of it, but they don't understand when it comes to from a forecasting point of view. And I want to introduce the concept of contract to capacity. This is contracted work over our revenue capacity. And remember, in our examples, the cleaning business, we had capacity for 10 contracts, capacity of 25, we had 15. In the service-based business, we had 25% capacity because of the expected charge hours, or of the total available chargeable hours, we only expected 75%. So to draw this example out, and we're going to look at 3 months, and you can see that our capacity is $276,000. This is looking at that service-based business that we had. And we have to look at the work that we currently have engaged. What could we work on if we did nothing else? And if we didn't bring in any additional work over the next 3 months, we'd be able to do $512,000 out of our $778,000 of capacity. That's about 66%. Not the end of the world, but it's also not great. So we're really going to look at what can we do to change that, or what should the ideal pipeline size be? And it's really based on 3 inputs: the average time that a qualified lead inquires about using our service or buying our product to them becoming an actually engaged client, the average length of the contract, and then what is my close rate? And when I talk about close rate, it's not, okay, I had 20 phone calls and 10 people bought. It's how many qualified leads came in that I was able to convert to a client. If I was a family law firm doing divorces and mediations and other things involved in family law, and one of my clients referred over somebody that was buying a business and they wanted us to help with the acquisition, it's not in my wheelhouse. It's not something I'm good at. I may refer it out and get a fee split, but it's not a qualified lead for what I do. I need to focus on how many family law matters people inquire about and how many of those meetings that I have convert to leads. So when we put all that together, it's our revenue capacity times the average sales cycle remaining in the period and the average contract length. Maybe end that where we talked about qualified leads. All right, so after we have those 3 numbers, here's the formula, and understanding the formula is a lot less important than understanding what it comes up with. But basically, we're applying all those factors to the period we're looking at. And in this case, we're looking at a 3-month period. So we're looking at 90 days. And when we apply those factors, we come up with what dollar amount the pipeline needs to be to fill that capacity. So we're looking at an average sales cycle of 60 days, length to do the work 90 days, and 90 days left in the period with a close rate of 50%. You can see that the pipeline we need is $354,000. If we tweak any of those numbers, it changes the math. So here's our 354 based on that set of facts. If we shorten the days remaining in the period, we only have 1 month to go, it greatly increases the pipeline need. If we shorten our sales cycle from 60 to 30 days, it decreases the ideal pipeline size. And if we double the length of our average contract length, it again influences what sort of pipeline we need. In its simplest terms, it's what's my capacity, how long does it take to engage a client, and how many qualified leads do I close? If you just understand that concept, you can begin to develop what sort of pipeline you need to fill your capacity. Okay, so in wrapping up, we talked about the 4 pillars of what we call profit-focused accounting. We had the cash metric where we talked about 10 to 30% of your money should be in the bank at all times so that you can make good business decisions and have less stress. We talked about production metrics and identifying those factors that really drive revenue for your business. Then we looked at the financial side, and we looked at more of the revenue side and where you allocate those expenses so that you can make judgments and investigate variances. And then lastly, we looked at the pipeline to wrap things up. So you can kind of see how these 4 pillars all work together and help you create a forecast that helps you run your business. As promised at the very beginning, we're going to give you a tool. This is a dynamic forecasting booklet that was written by one of our partners, Jody Grunden, and it goes into more examples and more detail of what we talked about. You can use this booklet to create your own dynamic forecast. Just scan the QR code and we'll get that to you. We thank you for listening. If you have any questions, feel free to reach out to either one of us. We'd be happy to answer any questions that you might have.
Thanks so much. Hope to see you soon.